You just ignore Ukraine and the Russian ruble. How do you bring that into your mix as you start the week?
Well, I'd say I ignore Ukraine because I think it's much more geopolitical than financial. The ruble, though, is something you would keep an eye on because it is tied to kind of what's going on in oil more I think than what's happening in Ukraine, and it does have some spillover effects into places like the Turkish lira. Seems to be pretty correlated with the ruble right now.
The gold is up. You like gold. Is it up like a new gold market, or are you just making it almost a trade from 1,100 up to something?
No, I think that bear market sort of hung around with us for 3.5 years, did a lot of damage to people, and it might really be over. I mean, certainly in non-US dollars, gold looks to be back in a genuine bull market here.
You know, one of the things we're all struggling to wrap our heads around are these negative yields we're seeing coming out of Europe. What are the consequences of that for your strategy?
Well, I think it makes gold more attractive than it was. I mean, the opportunity cost of owning it is basically zero. I mean, it doesn't really, the negative yields don't basically affect us. Fortunately, we're not managing money in Europe where we have those kinds of positions. You know, I'm not sure what it really means longer term for financial markets. But I do think one of the consequences is that central banks now hate cash. The central banks feel a political need to actually earn a return on their nation's capital, and I think one of the reasons why bond yields are where they are is the amount of central bank money and sovereign wealth money which is poured into fixed income.
Sort of opened the floodgates of money flowing into U.S. Treasuries.
I'm looking at your research note from last week for Marketfield, and I noticed that you pointed out that central banks are no longer concerned about volatility. They don't really see that as part of their mission. Should they have ever seen it as part of their mission to worry about volatility?
Well, I think when you have the kind of volatility you had in 2008, yes, and again a knock-on effect in 2011, but I think they went a little bit too far down that road. I mean, I think that the central bank started not caring what markets did in the summer of 2008 and finding out that it mattered a great deal for the real economy. Europe went through something similar in 2011, and then I think they stayed a little bit too long on that horse, and I think they've got off it now.
But you don't want central bank governors that are beholden to the bond market. You want them pursuing the dual mandate of employment inflation.
Yes, but I think they understood that if they allowed for bond, equity, commodities and everything else to go to hell in a handbasket in late 2008, there was going to be no employment.
What does a lousy January signal to you? Or we're already into February. Where did January go? And it was like negative 3%. Whatever. Does that mean, is that anything cosmic to Michael Shaoul?
No, but I think it does tell you that enthusiasm got a little bit ahead of itself by the end of last year. It doesn't necessarily tell us what happens in the next 11 months of the year, but I think by the end of December, you know, for the first time in many years, I think that the average investor's enthusiasm was ahead of reality in this market.
Do you see this rally that has been happening in the U.S. continuing?
Yes, but I think, well, I mean, if you're talking about the one from 2009, then yes, but with a lot more volatility attached, a lot more.
Meaning, is there a trading strategy around that? I mean, or is it just unpredictable volatility?
Well,
or as Tom would call it, stochastic.
Well, I think you'll see concerns build around. I think you'll see concerns build around certain ideas, whether it's lower energy prices being a problem or a stronger dollar being a problem, or I think later this year the Federal Reserve being a problem. I think you'll go through periods in which the market really gets concerned about.
Way to explain that. Later this year, the Federal Reserve being a problem.
Well, I think if we assume that the Fed is still on track to raise rates in the middle of this year, that'll give the market something else to worry about.
What a debate. James Bullard and Mohamed El-Erian flat out disagreeing on this on Friday. Let's have you clear the air here. Mr. Bullard was hugely respectful of what markets are saying about disinflation. Mohamed El-Erian said it had a lot to do with structural oil moves. Which is it? When you see disinflation signaled by five-year break-evens, whatever, what does that signal to Janet Yellen?
No, I think the whole bond market's crazy right now. It's taken a break off following economic data. I think there is no sign of CPI, but I wouldn't look at inflation expectations in the bond market and say that it tells me anything about the real economy.